The stock market is divided into sectors. But what do these sectors imply for the common investor? Investing in the proper industries might not only decrease risk, but also improve rewards. Sectors are groups of equities that have a lot in common because they are in the same industry. According to the most widely used classification system, the Global Industry Classification Standard, there are 11 different stock market sectors. Stocks are divided into sectors to make it easier to compare them to similar enterprises in terms of financials, business methods, and other comparative indicators. For example, one sector may include all healthcare companies, another may comprise all technology companies, and yet another may encompass all utilities. Knowing about each industry can help you diversify your investments, which is a vital part of building a healthy portfolio. Keep listening until the end to see how investors can achieve substantially better returns by understanding how sectors perform during different market cycles. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Energy. The energy sector includes enterprises involved in the oil and natural gas industries. It encompasses companies engaged in oil and gas exploration and production, as well as those engaged in the production of other consumable fuels, such as coal and ethanol. The energy sector also comprises enterprises that supply oil and gas producers with equipment, materials, and services. Surprisingly, it excludes many renewable energy companies, which are instead classified as utilities. ExxonMobil, Chevron, and Shell are examples of well-known companies in this area. Materials. This industry provides the raw materials required for other industries to function. The materials sector includes manufacturers of chemicals, building materials, containers, and packaging. Mining firms that extract gold, zinc, and copper are also featured, as are those that specialize in paper and forest products. Examples include International Paper, TOW, and BHP. Industrials. The industrial sector encompasses a wide range of business types, but is characterized by the usage of heavy machinery. Caterpillar, Raytheon, and Waste Management are all part of this single sector, which contains companies from 14 distinct sectors. Transportation stocks, such as airlines, railroads, and logistics firms, are established in the sector. This group also includes aerospace, construction, defense, and engineering firms that manufacture building items, electrical equipment, and machinery. Utilities. This sector encompasses virtually every form of utility company imaginable. Simply put, utility firms supply or generate power, water, and gas to households and businesses. Some utility companies offer multiple of these items or services. Furthermore, independent power producers and renewable electricity enter the utilities industry. These include American Water Works, Duke Energy, and PPL. Healthcare. The healthcare sector consists of two major components. The first category comprises companies that create biotechnology-based medications and therapies, as well as the instruments and supplies required to test those treatments. The second component contains healthcare equipment and services, such as surgical supplies, medical diagnostic instruments, and health insurance. Names like United Health Group and Johnson & Johnson are commonly associated with this industry. Financials. This sector includes all firms that deal with money. Banks are clearly important, but there are also insurance companies like MetLife, brokerage firms like Fidelity, consumer credit providers, and mortgage-related real estate investment trusts. Berkshire Hathaway and J.P. Morgan are two of the most well-known companies in the sector. Consumer discretionary. This category includes items and services that are fully contingent on the financial condition of the consumer. People acquire these companies' products and services when they have extra money because they are typically luxury items that aren't necessary. Even though food and Amazon products are regarded essential, McDonald's and Amazon are considered consumer discretionary stocks. When consumers have excess money, they spend it with these companies. Burberry, Louis Vuitton, and Ferrari are better examples of these stocks. Consumer staples. This is the inverse of the consumer discretionary sector since customers purchase staples out of necessity rather than desire. This covers companies in the food and beverage, textile, tobacco, and personal care industries. Supermarkets and other retailers that offer staples are also mentioned. Procter & Gamble, for example, manufactures diapers, laundry detergent, and toothpaste, items that people require regardless of their financial status. Information technology. The IT sector has grown in popularity over the last few decades since it includes organizations active in technical innovation such as Apple, Microsoft, Google, and others. Many of them are large and relatively new firms, owing to rapid technological breakthroughs. They concentrate on software, gear, equipment, and anything else linked to technology, which is important in almost any firm. Communication services. This is the newest of the sectors, and it contains a few key areas that were previously part of other sectors. Telecommunications service providers, which include both wireless telecom networks and traditional landline service providers, constitute one side of the sector. On the other end of the spectrum are media and entertainment companies, which include both traditional media such as television and radio, as well as interactive media such as the internet and emerging means of communication. For example, Simon Property Group owns shopping malls and outlet complexes, whereas Public Storage owns storage units and American Tower Corporation owns wireless and broadcast infrastructure. They could also own apartments, commercial buildings, or single-family residences. You should have a good grasp of what percentage of your portfolio is in each industry so that you can diversify effectively. During the dot-com bubble, investors who owned all technology stocks in the late 1990s were severely harmed. They would have performed much better if they had been well diversified and had a respectable portion of their assets in each sector. This may happen in any industry when money transfers from one investment to another, which is why diversification is so crucial. Some investors can boost their investment returns by purchasing stocks in an out-of-favor industry. Consumer discretionary, financials, energy, and real estate did poorly in 2022 when compared to information technology and consumer staples, presenting a solid buying opportunity. Some equities were on sale primarily owing to market uncertainty, while others were significantly more expensive. Those that bought the cheap sectors in 2022 with adequate foresight won handsomely when they rebounded later in the year. The S&P 500 has approximately 33% of its holdings in technology firms, 15% in consumer cyclical stocks, and only 2% in materials and communication services. The S&P 500 is generally regarded as a well-diversified investment, despite a relatively high concentration in certain sectors. There is no uniform definition of diversification. It is up to the individual investor to examine their investments and ensure that they are not overly exposed to any one sector of the market. A retiree may conclude that investing 33% of their portfolio in technology stocks is too volatile and risky, and that they would be better off investing equally in each sector of the market. They could choose to invest in an equal weight ETF, which owns equal amounts of each sector. Each of these 11 industries is a safe bet because it contributes significantly to our economy. We just would not be able to function as we do without all of them. Just make sure you're distributing your risk around the market rather than concentrating it in one region. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?